All right. Well, welcome to Trading Coach's Playbook. Good afternoon or good morning, depending on where you are. I'm Brandon Wendell. I'll be your host for about the next hour or so. So welcome everyone, and you should be able to see my screen, hear my voice, all that good stuff. And yeah, good afternoon, Brenda. Good afternoon, Kevin. Welcome everyone who's here. We'll go ahead and kick this off with our quick reminders we usually do that we are not broker-dealers or investment advisors. We're going to look at the markets here from an educational standpoint. So I'm not telling you to buy, sell, or hold anything in particular, give any personalized recommendations about the markets. All markets do involve the risk of loss, and that is always a situation. We can't eliminate that risk. We simply try to minimize and manage it when possible. We're also not subject to trading restrictions. We have positions in securities or initiate them at any time. So, as you can see, we are pretty busy here at Wealth Builders HQ. There's quite a few free workshops that you see on the right there. The Power Hour with Rob every Monday. Trading Coaches Playbook alternates every Friday. We got some stress-free trading signals workshops coming up as well. That'll be interesting. See what that's all about. There's a lot of premium workshops that we do, and I'm actually involved in quite a few sessions and workshops myself. You can follow us on the socials, of course. And one of the classes I'm going to talk a little bit about today is something I do with options, and that is the SPX cash flow secrets. Basically, my subject for today is going to talk a little bit about protecting our money when it comes to options trading. And there's other options programs here at Wealth Builders HQ. Mine, the SPX Cash Flow Secrets, focuses on generating income selling short-term options. But even though I have high probability for success, doesn't mean we're going to win every time. As a matter of fact, let's see here. I've got, where did I put that? I was just referring to this the other day. I can't find it. There it is. Tracking, yearly tracking for my SPX cash flow. This is the program. And basically, the win rates, I started the program in 2021, but I've been doing the strategy itself for about 15 years. And you can see my average win rate is over 80%. So I do quite well. As a matter of fact, this year so far, 2026, as you can see, my win rate is about 88.8%. So I've had some really good months and some decent months. And that's the thing. You want to build consistency, but here's the problem. We're not always going to win. And you can see that in this particular strategy that I employ, my average win is a heck of a lot smaller than my average loss. But the thing is, even though I'm going into these options trades full well knowing probabilities of profit, things like that, I am not going to take a 100% loss if I can avoid it. And what I mean by that is typically for these SPX cash flow secrets trades, and even the other trades that are out there, if you go back to some of the other programs, you have power option plays, and not every trade is going to be a successful trade, meaning it's not going to always win. Successful trade to me actually is a little different. It's meaning that you followed your plan. The outcome might have been a loss or a win. Obviously, we prefer the wins, but that doesn't always happen. But the key is successfully following your plan. And the plan allows for small losses or fewer losses than we have winners. And, it all comes down to risk management. So, as I said, I can talk from my experience. And what I'm doing typically is trying to predict, wrong one, trying to get to this chart. I got too many things open. I'm trying to predict where the S&P 500 is not likely to go by the end of the day. That's basically what I do. And I send out an SMS text message mentioning where I am seeing levels as well as the trade opportunities that I'm observing and taking advantage of in the markets. So for instance, actually, I forgot to log in, didn't I? Again, I always do that. And let's see, Wealth Builders, there we go. It might be logged in already anyway. Anyway, my point is that I always try to go for high probability opportunities, no matter what it is I'm trading, whether it's a directional trade or if it's a non-directional selling options. And the reason why I'm more on the sell side than the buy side is probabilities. Again, I'm all about high probabilities. When you buy options, for instance, and I'll go ahead and explain it here by looking at an option chain, and we'll look at the 0 DTE. Right now, the S&P index is trading at about 75.88. So we'll call it 75.90. If I think the market is going to go up from here by the end of the day, I could simply buy a call. And by buying that call, if prices do go above that strike by the end of the day, I may not win. Wait, what? Yeah, I might not win because it cost me money to get in. My break-even point on that strategy is where I'm getting in, the strike basically, plus the premium I'm paying in order to get in. So we not only have to have prices go in my favor, but they have to go far enough and fast enough that I actually can break even or start to make a profit. You can see it's not right at the get-go. So the problem with buying options is you only make profits one way. If the prices go in your favor far enough and fast enough. That's a lot of pressure. Now, the opposite is, what if I decide to go back and instead of buying a call, I sell a put? Now, selling the put, okay, let me get rid of the long call first because otherwise that's synthetic. Now, the drawback with selling a put is I'm capped on my profits. I cannot make any more than the premium I'm collecting at the beginning of the trade, which in this case is $760. My risk is huge, but again, we don't have to accept all that. But my point about this strategy now is I profit if prices go up, as I thought they would, and there's no limit to how far they have to go before I start making profits. They can even go sideways and not go anywhere, or they can even go down a little bit. If prices drop a little, I still make profits as long as it doesn't go below my break even point. So my expectation is that by selling options, I have a higher probability of success because I can make money if prices go in my favor, slightly against me, or go nowhere, three different directions versus buying options, you only make one direction. And I can also limit this risk by going back and not just selling that option, but also buying another option at a lower strike price. Now I have a cap on how much I'm going to lose if I'm wrong. Obviously, I still capped how much I'm gaining. And because whenever you reduce risk in the markets, you always reduce your gains. You can't go one without the other. So I capped off my risk. It's no longer, what was it, like 40,000 something? Now it's $695 for the max loss, right? So if I go back here real quick and do it like this, let me see, get rid of that buy one, analyze that. Now I can compare the two. Yeah, sorry, it was $757,000 risk to make 760 bucks. Or I could risk 695 and make 305. So it obviously is a huge difference. I've capped my reward, but I've also capped my risk by doing that. So that's one thing that we could do. Now, again, even though I've got a max loss, that doesn't mean I have to accept the max loss. I can accept to lose less than that if I choose. Let me get rid of this guy. Come on, there we go. So what happens is we have to understand kind of what's going on in the markets as a whole. And, when I'm talking about how we make profits, first of all, going back to just buying the call, let's see. There we go. Bring that up again. Analyze just buying the call. What you'll see if I compare the bottom here where the data is, I can see how I'm going to make profits, basically. You see what's called the delta. The delta is directional profits or directional risk, basically. And in the case of simply buying the call option, that's the bottom option right here, bottom choice, I should say, I basically have a positive 43 delta, which means that this strategy makes profits when prices go up. And it's actually quite a bit of profit because I make 41% of whatever the price movement of the underlying security is. So if we go up by 1 point, I make less than half a point profit based on that. However, you notice because I'm reducing my risk by doing the vertical spread, and that's adding in the short and long, I'm reducing my profits from that price movement. It is still a positive delta, which means this is still a bullish strategy. However, I'm not going to make as much money by price movement as I would by buying the call. But again, I'm also reducing my risk quite a bit. Instead of 760, it's down a little bit now to 695 for my potential risk. What else am I reducing risk with? Well, take a look at time decay. Okay, obviously this is zero DTE or 0 days till expiration. I wouldn't necessarily do that buying an option on the day of expiration because you can see I'm losing a whole lot of time value very, very quickly. And obviously with using a spread, I'm reducing the time decay. And this is kind of an extreme, but it's okay, it works. And I'm also changing my volatility exposure. So basically, if you're not too familiar with options, there's a couple different ways of, well, these are the Greeks are basically risk parameters. The Greeks. And let's see, I'll zoom in a little more so we get better font. There we go. So I mentioned delta, that is direction. Of the underlying security. And if you have positive delta, that profits from a rise in the underlying price. And if you have a negative delta, that option profits from a drop in the underlying price. Okay, we also have theta, which theta is time decay. So basically, again, we have positive and negative thetas. Positive theta, this profits from time decay. Basically, you sold and you can buy it back cheaper. There we go. How about my Grammarly there? It's doing the corrections for me. If we have negative theta, basically time decay hurts. Man, I can't seem to type very well today. It's Friday. Anyway, and what happened here is you bought and they're decaying with time. There we go. And then the last one, which I didn't point out yet, is Vega, which is volatility. And volatility changes that changes the options values. So once again, we get positive and negative. So if we have positive Vega, the value of the option arises with an increase in volatility. If you have negative Vega, the value basically it's because of what you did. Value always rises with an increase in volatility. So here it helps because you could sell for more than you bought. Okay, it's not really an inverse there because the value it rises with volatility again. You just sold. And you basically have to buy it back for more than you sold it for. So negative Vega, I should probably just type in, not be lazy. And of course, positive. So a couple things we can do, obviously, is to control risk in options. We have actually several different ways of doing this. One is what you trade, right? We could choose a different underlying. And the different underlyings will have different values when it comes to volatility. Just in this index that I'm looking at right now, I happen to be looking at the S&P 500 index, and there's options on those. And we can see if I go to the top here, close this out, there we go. You can see the implied volatilities on these particular options right now. The ended the zero DTE, or the ones that expired today, are about 19.36%. And the volatility drops from there. So we can choose a different index, perhaps. If I did NDX.X, that's an index option again, but for the NASDAQ. And once it loads, if it decides it wants to, there we go. We can see we have more volatility, don't we? We went from 19.4 to 21.56. This has more volatility and therefore probably some higher premiums. And you can see right here, at the money options have much higher premiums, 500 versus what we were looking at on the SPX. If we were looking at, say, the Russell 2000, they also have options as well. And the current options, 23% volatility. And they have, well, it doesn't seem as high, but again, you got to worry about the multipliers as well for the actual values on these. And you can do the same thing with stocks. If we take a look at a stock that might be a little more volatile, like Tesla, that might have higher volatility, 67% on the 0 days till expiration. So obviously, there's a little bit more danger when you have higher volatility. If you want something safer, I'll do AT&T options. That's not that much, 59%. Let's try to think of something. Maybe GE might have. That's pretty quiet usually. Nope, I take it back, 100% volatility. So maybe not today. But again, you can compare volatility rates and choose different securities to manage your risk. That's one thing we can do. Also, we can choose different dates. The expirations are not all the same. As you can see, in this case, we're going up a little bit in volatility. Then we drop a couple, go up, drop, go up, drop, and hold steady, drop a little bit. So we have what's called a volatility curve or volatility smile, and you can look at that to see where there's high volatility. And with high volatility, you'll also notice the higher volatility suggests that the expected price movement in the future is going to be higher. And typically, when you have lower volatility, you expect less price movement in the future. Now, of course, it could be higher because of time until that expires as well. But generally, as a whole, higher volatility, there's likely to be future price movement that's greater, and therefore the premiums should also be greater to compensate for that. Okay, again, there's also the factor of time, but choosing different expirations, you can choose lower volatility. And another thing that happens with lower volatility, typically, the bid-ask spreads are usually narrower than when you have high volatility. So right here, you can see we have almost a full dollar at the 325 strike between the call, bid and ask. But if we go out to this option, it's still $1.25, so still pretty volatile. But sometimes you'll see with lower volatility rates, you'll get tighter spreads. And the same thing happens with volume and open interest. If options are very heavily traded, they're going to have lower risk and therefore tighter spreads typically than options that have less volatility, or sorry, less liquidity, I should say. Another thing we can do is we can choose different strategies. And typically, what happens when you're choosing these different strategies is number one, single leg options. They basically are stuck or have certain Greeks. And whatever those Greeks are, that's it. You're stuck with it. So again, just looking at it doesn't really matter. I'll just go SPY or QQQ, maybe a little more volatility there. So go to QQQ and look at the options. And when I select one of these, whatever the Greeks are that happens to be on that particular option, that's basically what I got to live with. So if I'm bullish on this at the 740 strike, or actually 739, there we go. And I see I've got a 52 delta, negative 56 theta. And if I take a look at the analysis here, it'll give me the rest of the Greeks as well. Let's see, where is it here? I got to get rid of the old ones that I have. There we go. So volatility, Vega, I'm not really focusing too much on gamma right now, but that's another Greek, obviously, to worry about. It's related to delta. It's the rate of change. But volatility, I'm exposed. If volatility drops, I have risk. If I hold on to the option too long, I have risk because of the time decay. And I only profit if prices move up, not down. So another way of controlling the risk is basically creating a multi-leg option strategy because, whoops, wrong one. Basically, multi-legs we use those to offset the Greeks. Basically, when you're trading multi-leg options, your first option is the anchor leg. And that drives the profit and the strategy. So it tells you how you're going to make the profit and what your major risks are. The second option is basically the offset leg. And that manages the risks. It offsets the Greeks. That's why you do multi-leg option strategies. Because, as I said, with this particular single leg option strategy, I have risk if prices drop, I have time decay risk, and I have volatility risk. So to manage that, remember, I'm going to have to give up a little bit of profit to reduce my risk. And right now, max profit is infinite, but that's not realistic, obviously, because prices aren't going to go up forever. But I could always sell a higher strike option. And now analyzing the two against each other, first of all, I don't get as much profit. Instead of max, it's limited to 314. But what did I do? My max loss, instead of $800, I cut it down to about 300. Yeah, it's an insurance policy, exactly. But what else did it do? It adjusted my delta from 50 to 12 or 13, we'll call it. So I don't make as much profit if prices go up, but I still do. I'm still on the same side of the market there. I also still have time decay. But what did I do? I cut it down to 1/10 of the volatility, or sorry, of the time decay I was exposed to earlier. Because I added in an offset leg to reduce my exposure to time decay. And I've almost negated the volatility exposure. I went from 41 down to 2. So I have very little volatility exposure. If volatility were to collapse, which often prices can do if we get a nice bullish move that's very gradual, then I'll still profit from upward price movement, maybe not as much as I would have before, right? Because I'm capped, first of all, and I have less delta, but I'm still positively reacting to upward price movement. So that works out pretty well for me because I'm also giving up that theta decay. But I don't necessarily have to do just that. As I said before, I can get a little creative as well. And instead of buying an option that expires in a week, maybe I do further out. Let's see, I did the 739s, I think, right? And notice the single leg option, it's going to cost me more. So my risk is greater. I'm still haven't capped my profit though. And I didn't give up much delta. As a matter of fact, I increased my delta a little bit. But notice what I did is I reduced my time decay without having to add in and limit my profits. So I can either go out further in time, choosing a different expiration. Okay. Or I could choose instead of QQQ, and I'm not going to get less volatility by choosing individual stocks. I get more. But if I was comparing this to an individual stock, trading the index over the stock is lower volatility. Or I could choose an index option rather than an ETF option. That actually brings in a little bit extra protection. Again, in choosing what I'm trading, I can choose more or less volatility, right? I can also choose European or American style options. And if you're not familiar with that, then you probably shouldn't be trading options. But European style options can only be exercised at expiration. So for selling options, because there's that limitation, you might have a little less risk. Well, if you're getting a little less risk, you might also get a little less profit. The premiums might be adjusted slightly to compensate for that. American style options, they're free. They can be assigned, basically exercised for the buyer and assigned to the seller at any time the position is open. You don't have to wait until expiration. So there's a big difference there. And right now, choosing QQQ, those are American style. Index options, like the NDX options, typically are not. So if I were to compare, again, kind of apples to apples, right now, the 739 strike is 2166. I will say, yeah, 21.66 times 100 shares. That's $2,166 to buy that option. And that would be my max loss. If I did the NDX, first of all, how much volatility we have here right now? About 22%, 21 and a half. And that's at the money option. So now if I do the index right there, that is, again, not 2,100. It's 570 times 20. That's $11,400. It's not really comparing quite the same because in doing this NDX, I would actually have to do multiple ETF options to match this. Okay. But what happens is overall, because let's see, what's the volatility there? 21, it's about the same actually. 21.5%. The volatility was about the same, but these are a little bit safer potentially as a seller of options because these cannot be assigned early, which means that if I sell these options, that's one less thing I have to worry about. And it'll be compensated for it'll be slightly cheaper perhaps on the premium than if I had an equivalent American style option. Okay. So basically, what do we have? 11,000. Basically, if we went back to the QQQ, I think it's equivalent to like 500 shares or five options roughly. So again, if we're looking at 2160 times 500, yeah, that American style is actually a little cheaper, believe it or not. And there might be a skew there, which you can take advantage of as well sometimes. I'm not going to get into that. It's a little more advanced. But overall, typically, again, not always, not every single option, but typically you're going to find that European style options, because they offer a little less risk, because there's not early assignment, you may get less premium to a comparable American style option. But again, we can control that risk by first choosing what it is we want to trade. Then we can choose the expirations. As you saw, there's different volatility and different strikes and all that payment, everything, premiums are different based on when you have the expiration. We also can choose different strategies. If we do a single leg long or short, of course, shorts are a little too risky, probably not the best thing anyway, but a single leg long on a put, because you're bearish, you got to accept whatever Greeks those are. The only thing you could do is maybe adjust your strikes or your expiration. Then, if you want to control the Greeks a little bit more, you'd actually add in an extra leg and create a vertical spread or some sort of diagonal or horizontal, whatever you want. No, the great question. Can European options be exercised at any time at expiration date or only at the end of expiration? Only at the end. Yeah. Basically, once they're expired, then the exercise occurs. And typically, when it comes to European style, because many of them are on the indices, whatever you want to call it, they are cash settled, which means another nice thing about that is you don't have to worry about getting stock handed to you because you got to buy it. Like if you sold a call or if you sold a put, you don't have to go short stock. So there's no underlying security that you have to manage a position on at expiration when you deal with index options, which is why I trade those mostly. I'm not saying you shouldn't trade stock options or ETF options. There's definitely times to do that. And there's a lot of opportunity there. Again, you just have to be willing to accept the risks that go along with that asset that you're trading. Now, another thing that we can do to control risk, and the last one I was going to mention here, is setting stop losses. We can obviously set stop losses. As I said before, when we get into a position, especially when you're selling an option or credit spread, right? We either have debit spreads where you're buying options or credit spreads where you're selling options. And even though I say a credit spread, we're selling options, you're still buying and selling. You're doing both. But the net is what determines whether you're a buyer or a seller of options, right? So if I go back to my analysis page here, when I did this vertical spread, I bought an option. As you can see, let me get rid of this one for now. Hold on. Bye-bye. There you go. So I bought the 75-75 put and I sold the 75-85 put. So I bought one, sold one, but my net cost is a credit of 305. That makes me in a credit spread because I'm receiving a credit. Therefore, I'm a seller of options and it actually colors this in red. If I had done this differently, let's say I was doing this is zero DTs, right? If I was doing a bull spread here, perhaps I do a credit spread or debit spread here. We got 90, sell that one, analyze. Notice this option spread here. I bought the 75.90. I sold the 76.15, but it's going to cost me almost $8. Therefore, that's in blue because that is a debit spread. I am overall creating a debit position, meaning I have to pay to get in the position. Here, I'm getting paid to get into the position. And the losses are going to be relatively similar, but I mean, obviously, I can change that. What you'll notice typically is that on debit spreads, your reward is usually greater than your risk. And most traders have been taught that we want to have greater reward than we have risk. That's not always possible, especially when you're selling options. Whenever you sell options, typically the max loss will be greater than the max profit. It's just the way it is. So why would we even think about selling options? Well, I already told you, it's probability. I have a higher probability of success. This debit spread only profits if prices go beyond the strike that I bought by the amount that I'm paying. And it has to do it before the option expires. The credit spread profits less, but has a higher probability of profit because I profit if prices go up, down a little bit, or sideways. So higher probability. Actually, another way of showing it, let me see. I'm going to make sure it's in the right mode here as I go into something. Hold on. For some reason, I don't know why, but I gotta see if Tasty has a simulated mode because every time I try to log in, it only goes live. There we go. SPX options. There we go. And maybe in the legacy version, there is one. But right here, for instance, if I do a vertical spread, whoa, what happened there? Hold on, got logged out again. Sometimes it kicks me out like that. Oh, I know why. Hold on. Can't use a VPN. So that'll kick me out of everything and reestablish. There we go. Okay. So there we go. So again, the thing I like about this particular platform is it shows you how you can profit right there. So this is the debit vertical spread, basically. I buy an option either at the money or slightly in the money, and then sell out of the money options. Okay, and I think I was using 76.15 or something like that. So it'll show me where I profit. And I profit from basically not where I sold, or sorry, not where I bought, but where I bought plus the premium I collected. Matter of fact, let me zoom in more so we can see this better. There we go. How cool is that? It shows me, screen wise. I could do this on TradeStation as well if I actually enter the position. But right here, when I buy a call, I have to have prices go up above that strike price by the amount I paid for the option. Right? But if I do short put, now what happens? I can do an at the money or slightly in the money call or put, excuse me, and sell an out of the money or buy an out of the money put. So that's the vertical spread again, but I'm selling as a net credit. See, it says 205 credit. And now how do I make money? Again, if prices go up, I make money. If prices go sideways, I make money. And if prices go down a little bit, I still make money. How cool is that? So you can physically see there's higher probability for profit. As a matter of fact, it even shows me right here, probability of profit. In this case, 53%. If I go back, the long call, in the money, let's see, what are we at here? 51%, slightly lower. And the reason why is this has to go up for me to make any money. So you'll always have slightly higher probabilities, even though my risk, let's see right here, you see max profit 415, max loss 500. Going back to the other one, long put, short put, excuse me. Here, max profit 200, max loss 290, 300. So it's greater, but I have a higher probability of profit. And you can see why. There's a bigger green space. So that's a great way of visualizing the probability difference between debit and credit. Same thing if I just did single legs, buying a put or, I'm sorry, buying a call or selling a put, or buying a put and selling a call, either way. So the other thing that we can do, like I said, is just because when I get into a position, where are we here? What happened there? There it goes. Brought it back. When I get in these positions, this is a debit spread down below, the credit spread above. Okay. When I get into a debit spread, I'm basically paying to get in. So I'm at my worst case scenario, right? And if you look at the risk profile, I didn't mean to, oh, well, hit the wrong button. This is a debit spread. I bought a call and I'm selling a higher strike call. Okay. Once you enter, you're actually at worst case scenario because you paid for the options and basically got in at whatever the price is. Things can only get better. That's kind of an optimistic view, I guess, but that's really what it is. When you sell options, it's the opposite. Again, I'll go back and do that sell side here. 690, and I'll do a 10 wide spread. There we go. Analyze. So now looking at the vertical credit spread, now what happens? I get in at maximum profit, and the only thing that can happen is things could get worse. Yeah, it can't get any better. It can only get worse. Why can't it get any better? Because the maximum profit's the premium I took in. Remember, right? Oh, I didn't mean to close that other one out again. Dang it. Why do I keep doing that? Hold on. I just want to be able to compare the two. Analyze. There we go. So yeah, the difference between credit and debit, when you get in on a debit spread, you're at worst case scenario. Things can only get better. When you go into a credit spread, then you're at the best it's going to get. Things can only get worse. So it's a little more important when you get into a position on a credit spread to protect yourself, because you do have higher probability to win, but things can get worse than they are now. And worst case scenario, you'll lose more than you had potentially profited. So how do we prevent that from happening? We can put in stop losses. And it just depends on the platform you're using, how to place those stop losses. Sometimes, with Thinkorswim, Tasty, and a few others, when you get into a position, let's see, I don't have a simulator on this, which really stinks. But what happens is once I get into a position, I can change the type of trade. I don't think I can do this right now on this one, can I? Nope, can't do it here. Maybe advanced order. Let's see. Oh, there we go. I can put in right there stop loss and close at profit order. So I can put in what's called a bracket order. And you can do this after you get in the position, but it's probably better to do it before you get in with the trade. And again, when I'm selling options, as I said before, you're at your best case scenario. So in this case, when I'm doing this one, where'd it go? I close this out. Oh, there we go. We close this out. Nope, that's not what I wanted. Well, let me get rid of the bracket again now, will it? There we go. Just try it again. So basically, when I get in to this one, because I'm collecting that credit, I basically collect that maximum profit. I know how much I'm going to make. Let's say I'm going to make $2 in profit. And I closed out. Oh, well. There it is. Traders are often taught. I mean, this is what I learned in the times I was trading and educating, and I've been teaching trading for over 20 years. Basically, traders are typically taught that whatever your profit is going to be, your risk should be no more than 3 times what you were going to get rewarded. It's not always the best number to use, but it's a kind of a rule of thumb that many traders use. Some only use 2 to 1. And it's fine, it's personal preference. But right here, I can divide that by 3. And basically, if I'm going to make $2, I should risk no more than 67 cents. Now, how do I put in that, okay, I only want to risk 67 cents? It depends on the platform. Okay. So some platforms, on the option premium. So basically, and that's where I got here for this bracket. If I go in and say, okay, I'm going to do, so now where did I put the bracket now? That wasn't here. No. I forgot where it was. I hit it, oh, there's advanced order. That's what it was. So right here, stop loss, basically that's based on, and I can I change this to stop market? No, I can't. That's really weird that I have to do it like this, but I hate that. That's one of the complaints I have is that I can't make this a stop market order. So basically, I can only put this in as a stop limit with a trigger. So basically, I want to get out if I'm going to lose 67 cents. So again, let's assume I'm going to be locking this in at $2. There we go. So it's $2 that I'm going to gain. I don't want to lose more than 67 cents. So what'll happen is I'm selling that. I would have to buy back if it costs $2.67. And this is where it gets tricky because I actually have to put in a limit price beyond that level. Okay, so my trigger is going to be not, hey, why did it go 45? 67. It might only let me do nickels, so I'll do 70. Or actually, I can do 65. Round down, safer. And why is it not? Oh, because the limit's not there. That's why. The limit has to be above. There we go. So 65. All right. So basically, what'll happen is if I go in and collect $2, I will get a trigger if I'm losing 65 cents. It basically costs me that 65 cents to buy back the option. And my limit price, I just put it a little bit above. So that way it's got some room to try to get me out. Because once the underlying value of those options goes beyond that limit price, I won't get out anymore, which is why I wish I could do a stop market order rather than a limit order because I want to get out. It's going against me. And if it moves quickly, it can go really far against you. And then here I have to do a close at profit order. So if it goes down to a nickel, I can close out the position. I would actually only collect $1.95, which is $2 minus the nickel, basically. And that's it. So I can put on that trade. I'm not going to because it's live right now. It's a real trade. But basically, this is a stop to protect me if prices go more than 1/3 of my potential profit against me. So again, some allow you to place stops based on the option premium, and then some based on the underlying. It just depends. This is just, I mean, some platforms. So in this case, the preferred would be a stop market order. And that would basically, when the premium moves to or should be or beyond your price. And that would automatically exit you. Problem is, it's not always available. So instead, you might have to stop limit. So let me check something. Okay. So basically, you might have to use a stop limit. Stop price triggers a limit order. So if it's based on the premium, then the limit has to be higher for a credit spread. Now, I'm not saying you don't need to put in a stop loss on a debit spread. Okay. Just because you have maximum risk doesn't mean you have to accept that. You can actually, if prices start moving in your favor, you can lock in less loss or even some profits if you choose to. So again, if I go back and instead of this particular trade, I do again the long call spread right here, or actually this is going down. So let's do a long put spread. There we go. So I'll buy an in or at the money option and sell the lower one. So here it sees this DB. So that's dirtbag. I mean, no, debit. And again, if I go into my advanced order routing here, now I can close if it gets to a certain price for my profit, or if it drops to a certain level, then I can exit. So again, if the premium, remember, I bought this and I could sell it for less than I purchased, and therefore I can go ahead and collect less money back when I sell it and reduce my loss. So I don't have to lose 100% of what I paid for it because there's still time value left and some intrinsic, well, there's no intrinsic value yet. A little bit actually. So again, since I'm primarily on the sell side, the limit price has to be greater than the stop price. If you're doing a debit spread, it's the opposite. It's lower than the stop. Now, when we deal with things like TradeStation, close that other one out, it's a little different here, depending on which version of the platform you're dealing with. I think Titan X, you can still do the premium as well. But for instance, here, if I do this, you do debit spread again, or credit, excuse me, credit spread. And I'm doing a bull put spread right now. Let's see. Currently 75.87. Now let's do a different one. I guess I'll do a bull spread. We'll do 75.85. And I'll just do a 5 wide spread. There we go. So I'll analyze that. And basically, I'm going to collect the 205 again. So if I do this, actually, let's just do natural. It's going to fill. Come on. Hey, when it doesn't fill like that. I thought I did the natural price. Should have filled right away. And try it again. Let's go back. Come on. Options. And there we go. Natural. Oh, that's why I dropped a lot. Come on. Cancel replace. Make it even easier. Market. That'll fill. Good. Now it's filled. All right. So where did I get filled? I got filled on this vertical spread right there. So how much did I collect? Showing my, man, it's showing a loss right now all of a sudden. It's not showing my trade price, is it? It's kind of weird. I should have gotten filled around $1.40 or so. Where did I get in here? Manage. It's 85.80. Oh, there it is. No, that's the current price. Trade price, 30 cents. Whoa. That was a little bit of slippage. That is not good. Anyway, let's assume I got $1.80. Okay. Basically, what I would do then is I can go in, right click on the position and close this position because that's a debit spread. I only collected 30 cents, which sucks. But anyway, um, basically, I go to close the position here. Here's my order box. And what I need to do now is I could try to put it with a limit price, but the problem is I'm going to buy to close this because I sold to open, and any price I put is going to do that price or lower. Well, that's not really what I want to do. I want to, if the price goes up, it's going to cost me. So instead, I'm going to change this to a market order and use what's called activation rule. This is where I have to base it on the underlying securities price. So let me go back, and instead of this live position, because it's a terrible position to have been in, but that's okay. We'll go back, and again, I've got, there we go, analyze, limit, let's say $2. That's the example I was using, and analyze it. There we go. So now we can mess with this a little bit better. There it is. This is a $2. Did I do this wrong? I did. I did it inverted, didn't I? Stupid. Hold on. This one I did correctly. I just did it wrong on here. So we would need to sell the upper one, buy the lower one. There we go. For $2. Analyze. Now it's right. So right here, we got a $2 credit that I'm receiving for getting in that position, right? There it is. What I need to do now is set my stop loss based on how much I'm willing to lose, which I determined is about 67 cents, right? Now, here's part of the trick of this is, how do we set that? Do we set it based on where we are right now? Do we set it based on the future? Probably shouldn't have done a zero DTE option for this, but that's okay. I could just set it based on the expiration because, again, my goal is to let this expire worthless. So what I would do is use these price slices, and I only need one, not two or three. So we have the current price. And right now, at the current price, at expiration, I would gain basically $130 out of the two. Well, technically, at expiration, if it's above a certain price, basically the option I sold short, I would get the full premium. But because we're below that price right now that I sold, 75.85, that's right at it right now. But again, it's showing me that I'm not going to collect all $200. There it goes. Now it's back above. And when it goes below, that's going in the money. So I'm going to collect less, basically. What I could do is take the other price slice, which is in no man's land right now. There we go. And I can adjust that. And you see that theoretical P&L, how it's moving right here? I can move that to where I'd lose $67, and that's 75.8233. That's where if the prices are at expiration are at 75.8233 or lower, I would theoretically lose 1/3 of my potential gain right now. That's it. So I basically have to adjust the price slices. And if I have like an iron condor where it's both sides, I do that. I just use price slices on either side, slide them around until I see I'm going to lose roughly 1/3 of my potential gain. No big deal. And now that price, 75.8233, I go back to my trade order here. And remember, this is a close, so I need to go actually to the open position, which I don't have, but I'm just going to put this as a close order. Okay. And I would close this with a market order. This is going to make it a stop market order by doing this. Okay. So basically, if I have an open position on this with the $2 profit currently, I would go in, right click, and say close this position. It'll give me this little order box, change it to a market order, and say, okay, now if I hit this right now with a market order, it'll immediately exit at whatever price it is, which last price, that's not based on the current though, with time. Let's see, is that, yeah, that's right now. I'd actually lose, well, it'd be about break even currently. That's where this gets tricky because do I want to do this now or do I want to set it based on the expiration? I typically set it based on the expiration so I don't have to keep adjusting. What you'll notice if you do it on the current price and I start adjusting this, I'm going to have to keep playing with it as time passes and adjust my stops. And I don't necessarily want to do that. So instead, to keep it easy, I just move and get that back down to 67. 75.8233. Great. So I have my order open, closing the position, market, activate this, and right here I use this little ellipsis button. That's what that's called, the three dots, the ellipsis. And I'll say, look, I'm going to go ahead and exit this when the index goes down to or equal to 75.82.33. Too many eights. There we go. So basically, I'm putting in a stop limit order. This is the stop price right here. Oh, I actually stop market order because the market order gets filled as soon as this gets triggered. And it'll only trigger if the SPX drops to that level, which based on the price slices. Now, keep in mind, this is theoretical price. It's not exact. Okay, so it may or may not be exactly that level, but it's about that level. Now, the other thing is right here, trigger type. I'm not going to go into all the explanations, but you can look at a little bit more. If you go into, I think it's question mark right here. Hold on. Let's hit OK for now. If I click the question mark for help and type in trigger type, it'll explain a little more what those trigger types are. There they are. So it'll explain basically what happens is sometimes you get what are called late prints where a trade occurs, it doesn't get reported right away. So to prevent you from getting a stop loss triggered too early, you can actually do double trade tick, meaning there has to be actually two trades inside that certain level rather than just one trade, which could possibly stop you out too soon. So again, if I go back, let me get rid of this position for now. And I'll do QQQ. Again, it doesn't matter what security I'm doing this on. There we go. Close these out. And if I go to my options on QQQ, let's see. There we are. Let's say I'm going to play this a little bit longer time frame. Now, on a daily chart, we're still pretty bullish. And I want to do something a little different, though. I don't want to just do one side. I actually want to do two sides. So I'll use fib price extension and project. There we go. So we're already at a Fibonacci extension level, but let's say 765 is my next target. And we got no, maybe not 695. Let's see what this is. Let's say 720. So 720, 765. There we go. Just arbitrary numbers is not an actual trade I would take. So if I'm willing to collect some premium on this, maybe I do, I don't know, 28 days left till expiration. Do 40. Okay. And basically here, I'll just do, I need more strikes. Let's do 45. There we go. So I'll sell a 720 put, and I'll just do a 3 wide strike, 717. Then we have the 765, so I can't even go that high. I'm going to just do 757, 760. There we go. So I'm going to create this spread, which is about $1.69 right now. Let's see if I can just place the order and get in. I don't know why it's not filling right away. It should have filled. It's really weird. Natural, mid. Because if I try to do it as a market order, it's probably not going to fill at a good price. So let's just do this way so I can end this. Let's see, 720, 717, analyze. Oh, I did it wrong. Natural, analyze. All right, so 168 is what I would collect if I put in that order right now. Okay. And this is an iron condor. So basically, I'm going to need an extra price slice. I could just use these two and not the actual last price because I don't really need that, but I like to have it. So let's go to plot 1 at expiration. And let's see, 740. I'm just putting them in the area so I can actually see them. There we go. And now, since I'm collecting $1.68, I got rid of that. I need to know how much am I willing to risk. So $1.68 divided by 3 is 56 cents. So all I have to do now is figure out what price I would lose 56 cents. And that would be, let's use last. There we go. Nope, wrong one. When I do that. So I adjust this and 59, 56. This one. Nope, just had it. 56. I can keep this at last price. I always like to keep an eye on that anyway. So at expiration, if we expire right in the middle here, then obviously I get to keep the premium, which is 168 bucks. My max loss, this one's actually good, 132, but basically I want to limit my risk. So in this case, I actually have 2 strikes I would be needing to use, which is, or not strikes, 2 prices. On the downside, 717.76, and on the upside, 759.24. If the SPX goes and hits either one of those, I want to be stopped out because that should limit my risk to roughly 1/3 of my potential gain. So how do I do that? Well, obviously, I'd already be in the position. I'd right click on it and say close this position. And it would bring up an order ticket that looks like this. I go to a market order, activation rule, and the ellipsis button. And now I say, okay, QQQ. But I'm going to use 2 because I want, if prices go above the 759 or if they go below the 717. Be careful because you got to change the operator here and won't work because prices can't be up, above, and below at the same time. So don't forget to change that. It's got to be either above or below. And then I can put in, okay, on the high side, 759.24. On the downside, 717.76. Now, if the prices go there quickly, I could get stopped out for more or less. And you can see why, because that's the current curve right here. This is only at expiration, which is typically I'm going to try to hold on until expiration, but right close to expiration, if this happens to move that far that fast, then obviously that's where I would have a possible different price adjustment here. So right now, if we hit the stops, I'm only going to lose $12. If we hit the stop on the top side, lose 33, not 56 or 57. But the closer it gets to expiration, there we go, a little further, it changes. And then at expiration, worst case scenario, I will not lose, hopefully, more than 1/3 of my potential gain. So using price slices, I can adjust and basically figure out where I can place my stop losses. And that's how you do it to protect yourself. So that is a little bit more about option risk management and things we can do to control the risks. Change what you trade, choose different expirations, choosing different strategies by adding extra legs to adjust the risks, and set stop losses. So if you guys have any questions, let me know. If not, I'd love to see you in one of the programs here at Wealth Builders HQ. We got a lot of education when it comes to options to help you be successful. So thank you very much for being here, and I'm going to take off. Have a great rest of the trading day and weekend. Trade safe, trade well, everyone. Take care. Thanks.